also doing this protection activity, because generally it is for application of patents, copyrights, etc. So it's like, if you have developed an intangible, uh, you might want to have it patented into your own name, right? So it is possible that the who has developed, they are applying for a patent, but again it depends uh, upon the actual functions. It could be possible that one entity has developed, but the other entity did in the enhancement and the maintenance. And as a result of both these activities, now when the product was or the asset was developed, it was not fit to be patented, because certain countries have technical laws as to that this intangible needs to classify these many quality checks before it can be patented. So it could be possible that the entity has developed, one entity has developed, but the second entity in the group has done the enhancement, done the maintenance. Because of that, the asset has now become qualified, technically qualified to be patented. So that's why the second entity and the first entity both can apply for the protection. So this is just for an example which I'm giving. So it could be possible that it's not always that the entity who has developed needs to apply for the protection. It could be other group entities involved as well. So this is towards protecting, the asset, that it belongs to your group and your ownership lies in that. So you are the legal owner of this, asset. Uh, the last is something which is called exploitation, right? So here I would just like to bring a small concept of legal ownership versus economic ownership in intangible. So legal ownership, as the name suggests, it's more towards the entity who is the owner or the owner of the patent, or who has applied for the patent for the intangible. So generally they are the one who hold the title of the intangible, and they are the entity who are having the legal ownership, right? But the more important element to be analyzed in the case of an intangible and the DEMPE is the economic ownership, right? So generally, the last E, exploitation, is something which leads to the enjoying the economic benefits of the intangible, or the entity who are vested with the economic rights. So basically, this means the using the intangible, enjoying the intangible, deriving benefits or returns from the intangible, right? That means usage or licensing, etc. So this is something related to the economic ownership. Obviously, legal and economic ownership are also quite different elements of an intangibles, which require another separate session for discussion. But I just wanted to bring these two terms here because they are important in terms of protection and exploitation. So exploitation would include the functions leading to enjoyment of the intangible assets as part of the economic rights. So in this case, uh, one would be the in case of a royalty kind of, or a license fee, one would be the licensor entity who is providing the intangible, right? And the other would be the licensee who would be enjoying the rights or the usage of the intangible. So that's why exploitation also becomes here important to understand as to what kind of rights the entity who is using has for the intangible. Accordingly, the return for the licensor or the entity who has given the intangible needs to be determined. So in a sum and substance, the DEMPE is important for each entity of the value chain to determine their profitability and their returns and the costs involved towards the intangible. So it's not possible that we can exclude three activities and just focus on two. By law and by the by technical definition, we have to focus on all these five functions along with the FAR analysis, the functional assets and risk analysis. And then we come to a conclusion that this entity in the value chain is performing this kind of DEMPE and FAR, so they need to be given this much of return, and other entities. Yeah. Okay. So now coming to you know uh, the last two slides as to what are the transfer pricing compliance requirements. So first, now coming to the loan transaction. So as I mentioned earlier, the loan transaction must be carefully analyzed with an appropriate interest rate, because uh, the interest-free loan arrangement is completely being disregarded, right? So the most important is a loan benchmarking analysis. Then comes the transfer pricing document, right? To support the analysis, and preferably intercompany loan agreements should also be there, right? So the foremost are the benchmarking and the documentation, and then the loan agreements, because they also act as a cushioning effect to substantiate the benchmarking and the uh, documentation, right? Now, for a loan transaction, if the so in case of a loan transaction, we need to examine the principal, loan amount. Unlike, other transactions involving sale, purchase, or services, etc., wherein we just look at the transaction value, right? But for the loan, it has two components, principal and interest, right? So if the principal loan amount is 15 million Sing dollars or Singapore dollars or more, then a proper database based benchmarking analysis is required, because of the fact that the database analysis based results only will prove that the interest rate is at arm's length. So generally, what we have seen in our experience, that some times people have this understanding that we can compare it with any XYZ market rate or any published rate. So that is not actually the correct way of doing it. If it's the principal is 50 million or more, then a proper database analysis using a proper financial database needs to be undertaken, uh, because there are many elements to be analyzed, for intercompany loans. We have to see the credit rating of the borrower entity, the nature of the loan, the tenor, the transaction details, etc. So that's why, comparing it with just third party market rates published in any, magazine or something or any other situation will not be the correct way. The correct way will be to do a proper benchmarking, right? Now, for a loan transaction, if the value is less than 15 million, then there are two options available. Either one can just apply, the indicative margin rates, available on the IRS website, which they do it for every financial year. Uh, or if the company wants to, to have a more robust kind of analysis, then a proper database based benchmarking should be there. But sum and substance is, uh, interest free is not acceptable now. Depending upon the principal, loan amount, either a database based benchmarking or an indicative margin rate analysis should be there, but there has to be some basis of justifying that this chosen interest rate is at arm's length. It could be possible that sometimes the group per se has an intercompany loan done at the group level, but that is something undertaken from a group loan perspective. From an individual local entity or local laws perspective, we will still need to analyze that whether that loan analysis conducted is in compliant with the local and the legal requirements as of the law of the land. So that is also something which requires a proper check and to understand that whether this loan transaction, based on the three-step approach which I just mentioned, is actually a loan, and B, based on the local regulations, what is the acceptable interest rate, right? So as I mentioned earlier, that the comparable uncontrolled price method is generally used, and for using this kind of method, again there is three elements or the three steps should be taken. So first is conduct a comparability analysis. So as I mentioned, there are many elements to be seen. Factors like nature and purpose, market conditions, tenor, principal, duration, credit rating. So the loan has itself, many levels of elements to be analyzed before coming to a proper analysis. Then is identifying the most appropriate method, and finally they determine the arm's length rate or the arm's length results. So these are primarily the compliance requirements for intercompany loans. Now, coming last towards the intangibles, right? So for an intangible related transaction, uh, most of the important characteristics to be analyzed is including the nature of the transaction, because the nature of the transaction, as is mentioned here, it could involve intangible assets, right? Which will have elements like royalty fee or license fee or trademark fee, brand fee, etc., etc. So that's why we have to first of all analyze as to what is the nature of the transaction, then what is the type and the nature of the intangible. Uh, the duration and the extent of the rights, again, if they are available in the agreement, that's quite helpful. And the benefits available, because I would lay a little bit more emphasis on the benefits point, because at the end of the day, uh, one entity would be making certain payments for the usage of that intangible, right? So there has to be some proven benefit for that entity by using that intangible. It could be achieving operational efficiencies, or sharing of best practices, or understanding the intangible assets, utilizing it, and trying to produce an own intangible in its own local operations. Just a hypothetical situation. So there has to be some benefits anticipated, although they don't need to be absolutely written or legal or black and white, but at least some basic level of backup analysis has been conducted by the group, that okay, this, by using this intangible, right, I will have this much of returns, and my returns are much more higher than my cost. So that is something uh, is also very important for an intangible kind of situation. So as I mentioned, typical transactions: royalty fee, license fee, trademark fee, brand fee, etc. So for this kind of transactions, just the key amendment which has been made is that for financial year 2024. So right now I'm taking financial year 2024 as 31st of December ended, 2024. The individual transaction quantum for each set of transaction involving intangibles was 1 million, and for the years before, uh, from this year onwards, that is 1st of January 2025, it's now 2 million, and onwards till the time there are any other future amendments, right? So depending upon the nature of the transaction involved, uh, the appropriate methods are generally the CUP, the comparable uncontrolled price, or the transactional net margin method. Sometimes, depending upon the nature of the intangible, we can do a corroborative kind of analysis, wherein wherein we can use the CUP and the transactional net margin method, but it all depends upon the facts of the transaction. But in majority of the cases, these are the either of these two methods are being used. Again, it's majority uh, bending towards the comparable and control price, but in certain cases it can be also be the usage of transactional net margin. But again, the main point to emphasize here is that a proper analysis of a benchmarking is required in case of specific transactions involving intangible assets. And depending upon the revenue of the company, if it's more than 10 million or less than 10 million, but if the transaction values are exceeding the thresholds which we have just mentioned, the analysis will have to be captured in a full documentation or a memorandum or a memo to ensure appropriate compliance, because the analysis and the documentation along with the agreement forms a defensible position before the tax authorities, that for an intangible kind of transaction, these are the elements and these are the analysis involved, and where the supporting documents are these to support and validate the chosen interest rate for loans, or chosen royalty fee rate or license fee rate or trademark fee rate for an intangible. So the benchmarking and the documentation is critical, and agreements also do a lot of assistance when there is any potential queries, and to ensure compliance, right? So I think, yeah, so that is all from our end, because we wanted to have some time frame for taking up any questions from your end. But as a concluding remark for both loans and intangibles, so you can see the loan in itself has very different dimensions to it before benchmarking, even analyzing whether it's a loan or not a loan, and then understanding the credit rating, the loan tenor, the interest rate, etc. Similarly, for intangibles, most important is the DEMPE analysis and the FAR analysis, and then determining which kind of method to be used and what are the benchmarking requirements, and how it is to be documented in a proper deliverable kind of a base document. So these are the main critical elements, and that's why we had chosen these two, because in terms of the transactions, what we are witnessing is that there is more focus on financial transactions and these intangible related transactions in today's landscape. So that's why the compliance with the laws related to these two specific set of transactions becomes very important.